Hi, welcome. It's been a while since we chatted, and so here we are again. I'm Sumera Abdi, and I have with me Gaurav Mehta. He's the Chief Investment Officer of the SBI Alternatives business. So, Gaurav, on AEON Alpha, last year it did phenomenally well, right? But since November, we have seen a bit of underperformance that's coming in. A lot of it is also because we've seen value stocks do well. But how are you looking to sort of course correct? Is there any change that is required in your strategy, or should investors keep the faith for now?
You're right that if I look at the year as a whole, we've done well. But if I look at the last 4 months specifically, then you're right that there's been a degree of underperformance, which I can attribute to a couple of, or rather three specific factors. The first factor is that when you look at the performance versus an index like the Nifty, I think last 4 months Nifty has done its own thing and it's actually surged some 11 odd percent if I'm not wrong since November end till March end. Uh, but when you look at the broader markets, they've been very different. So I think an average small cap over this 4 month period would have done 3 to 4%, maybe a little shy of 4%, while the Nifty itself was up 11%. And then again, when you look at the breadth of stocks, we think that something about one third of the top 500 stocks were actually negative through this 4 month period, even as Nifty was surging 11. So to that extent, there was a bit of disconnect between broader markets and the index. And our portfolio overall tends to be a multi-cap strategy with a skew towards mid and small caps. And over short periods, what Nifty does and what mid caps and small caps do obviously has some bearing on the portfolio. But what we are thinking of is that if you were to think of a 3 year investment horizon, what matters the most for investors is to go down the market cap spectrum, look at companies which can grow non-linearly versus their larger peers, and at the same time these companies also tend to have more research arbitrage because not a lot of institutional money is looking at some of these names. To that extent, and again, we are a multi-cap strategy, so we are not open to investing in large caps. If a large cap provides a good risk reward, we are very happy to exploit that. And to that extent, we have a decent mix of large and mid cap stocks also in the portfolio. But just because of the research arbitrage and that non-linearity that could potentially come from smaller companies, the portfolio tends to be a little skewed towards small caps. And in periods like the last 4 months, when small caps are not doing well, when the Nifty is doing well, you tend to see a little different outcome on the portfolio versus the index. And the second related aspect is that we also tend to run very high active coverages. Right, so our overlap with the index like the Nifty is very limited, maybe 20 odd percent, not more. And which again means that over short periods, the outcomes that we deliver are very different from the index. I think till November we were doing much better than the index, and November on was Nifty isn't better than us. But I think that's part of the game. I think what matters is that over long periods, would your companies grow at a much faster clip and profitably versus the index or not? And if that happens, which going down the market cap spectrum we think does bring that non-linearity element to the portfolio, then I think you are pretty fine. So, overall, we don't think that there is as such a need to course correct. You talked about value doing well. I think we tend to think of the portfolio as core and satellite. Core is where we play structural ideas. Satellite is where we play, these turnarounds or value opportunities. And to that extent, we think there's a, almost 50-50 kind of a mix towards both these pockets. So again, from that point of view, we don't think that our portfolios, are not having the right mix of value or growth opportunities. We think we have a good marriage of the two.
So, right, you mentioned about the volatility, right, in the small cap space, and we have begun to see it. There is this tilt in the SBI AEON Alpha towards mid and small cap, like you mentioned. Is there any further, reassessment of the risk framework that is required because of these fluctuations? I mean, I know you've already put in place pretty much everything, but every bout of volatility teaches you something, right? So is there any more that is required to ensure that over the longer term we can maintain the performance and the outcomes that we desire?
I can answer it at multiple levels. Obviously, we have a very robust internal risk template in place, which we've created with help from the risk team, which has aspects around illiquidity, etc., which we very clearly adhere to. So to that extent, there are checks and balances around how much can we go in small caps, how much illiquidity can we carry at any point in time. But beyond that, I think the risk mitigation on a practical basis comes from two different factors. The first is that when I look at a portfolio, on parameters like ROEs or earnings growth for that matter, financial leverage or beta, on most of these counts, the portfolio looks even better than the Nifty. So our ROEs are better than the index, the portfolio versus the index. Our financial leverage is lower than the index for the portfolio. The beta of the portfolio is lower than the index, and the earnings growth expectation is higher than the index. So to that extent, just by skewing ourselves towards mid and small caps, we are not inherently increasing the fundamental risk of the portfolio. The fundamental attributes are even better than the index, and which again, goes back to the point that we're going down the market cap spectrum not to sort of look for high beta, quick money making ideas. We're going down the market cap spectrum because we see promise for non-linearity and research arbitrage. And a related aspect on the risk management point is that across the portfolios and across market caps, we are always thinking of this balance between core and satellite. Now, core are ideas where you're thinking of long-term sustainability, high ROEs, high cash generation, and so on. And these are essentially ideas where, if the markets were to shut themselves down for the next 10 years, on the other side of that 10-year period, you will still be very comfortable holding these stocks, because these are structural ideas in sectors which have relatively secular tailwinds and managed by good managements. And this core piece is about, let's say, a little over 50% of the portfolio. But we also complement it with the satellite piece, where we are looking for cyclical ideas, turnarounds, value opportunities, a theme that we think will fructify over the next 2, 3, 4 years. Now, the satellite piece provides non-linearity to the portfolio, but the core piece also provides solidity to the portfolio. So even with a small cap skew, when we see very turbulent markets, of a vertically falling market, the core piece tends to ensure that we are still sort of well placed from an overall risk point of view. And then when you have a raging uptrending market like the last 12 months, the satellite piece ensures that we also give you sufficient participation on the way up. So I think this mix of core satellite is in itself sort of provides a degree of solidity to the portfolio. And to your point on risk, it sort of helps manage it well without compromising on returns.
All right, Gaurav, thanks so much.